If you look at the numbers TOTA, the U.S. national debt has surpassed an almost incomprehensible $38 trillion. To visualize $38 trillion, stacking $1 bills would reach far beyond the moon, illustrating the scale vividly. Most people miss how serious this is, but it is a structural problem affecting every American's finances directly. For decades, politicians reassured citizens that debt was manageable, owed to ourselves, and economic growth would cover it. That outdated thinking is dangerous today. The reality of interest payments is much more severe than most imagine. Interest on the national debt now exceeds the entire U.S. defense budget, redirecting enormous resources from national security. In fact, nearly $1 trillion per year is spent simply servicing debt already borrowed, creating a looming fiscal crisis. Unlike households, the government cannot easily stop spending because Social Security, Medicare, and other mandatory programs are untouchable. To cover the interest on old debt, the government issues new debt, creating a self-reinforcing exponential feedback loop. Borrowing to pay interest increases total debt, raising next year's interest, forcing further borrowing, and repeating the dangerous cycle. Conventional fixes like cutting spending or raising taxes are politically impossible and would trigger immediate economic collapse. Theoretically, there are three ways to address this debt problem, but only one is realistically feasible today. First, austerity would require massive tax hikes and severe spending cuts, which no politician can implement safely. Imagine cutting Social Security by 30% or doubling income taxes. Both would destroy political careers instantly. The economy relies heavily on government spending, so austerity would likely trigger a depression similar to the 1930s. Second, default means refusing to pay bondholders outright, a tactic used by Argentina or Russia in past crises. For the U.S., default is catastrophic, as the global financial system depends on treasury bonds being risk-free. Walking away from debt would collapse global trade, freeze credit systems, and create a worldwide financial apocalypse overnight. That leaves the third option, a slow, polite default, paying debt with currency losing value due to inflation. This process quietly erodes the real value of $38 trillion while nominally fulfilling all obligations to bondholders. Inflation acts as a hidden tax, transferring wealth from savers and fixed income holders to the government effectively. For example, at 5% inflation, $1.5 trillion of debt is erased every year without raising a single tax. This method, financial repression, has historical precedent from post-Whipped United States and post-war European economies. It relies on keeping interest rates artificially low while inflation steadily erodes the real debt burden over time. Today, the Federal Reserve cannot act independently because raising rates too high would collapse government finances entirely. This forces the Fed to tolerate inflation and support Treasury spending, creating an era of fiscal dominance. Most people miss how this affects them. Savers earn low interest, but their purchasing power steadily declines year after year. The first recipients of new money are banks, hedge funds, and large institutions, benefiting before prices rise. Ordinary workers only see wage increases after inflation has already reduced purchasing power, widening wealth inequality dramatically. This is why the top 10% owning assets have seen their wealth explode since the 2008 financial crisis. Modern tools also make this process invisible. U.S. Treasury bonds are legally required holdings for banks, pensions, and insurance companies. Banks must buy these low-yielding bonds to satisfy liquidity coverage rules, regardless of risk or potential losses. Another tool is CPI manipulation. Inflation measurements are understated through substitution bias, reducing Social Security and TIPS payouts. Hedonic adjustments also reduce reported inflation by adjusting prices upward for quality improvements, saving the government billions annually. Effectively, citizens lose purchasing power, while official statistics suggest cost of living increases are minimal or moderate. The Fed also functions as a buyer of last resort when foreign nations slow or stop purchasing treasury bonds. This suppresses yields, keeping government interest affordable but flooding the economy with new money and inflating asset prices. Stock portfolios appear higher, real estate values climb, but your actual dollars buy less than a decade ago. Wealth is redistributed invisibly from savers to the government, which uses inflation and regulation as tools to extract value. Cash savings, once considered safe, now guarantee losses in purchasing power as real inflation exceeds nominal interest rates. Government bonds also fail to protect wealth because their yields are below actual inflation, eroding capital over time. The safe option no longer exists. Preserving wealth requires riskier investments such as stocks, real estate, or crypto assets. This is forced speculation. Citizens must take risks to outrun inflation, as traditional savings are intentionally destroyed. Physical cash has been a limited escape, allowing people to withdraw funds to avoid penalties or negative interest rates. However, a digital dollar or CBDC will remove even that last safety mechanism, giving government total control over money. Negative interest rates could be applied instantly, and spending could be mandated through programmed expiration dates on digital balances. Pilot programs abroad, like China's digital yuan, demonstrate the potential control over currency and financial behavior once implemented. With a fully digital dollar, slow default and inflation become inescapable, ensuring the government's strategy succeeds unnoticed for years. Citizens must therefore protect wealth through tangible or finite assets the government cannot print or manipulate. Real estate, precious metals, profitable private businesses, and Bitcoin become critical stores of value in this new financial environment. Traditional, safe investments like cash or government bonds no longer function as protection against inflation or purchasing power loss. This is a deliberate, long-term transfer of wealth, quietly moving resources from ordinary citizens to the Treasury over decades. The $38 trillion debt will never be repaid in real terms. The strategy is slow, bureaucratic, and invisible by design. Ordinary savers effectively subsidize the debt through low-yield accounts, while inflation diminishes their purchasing power consistently. Asset owners who invest wisely are the winners, while those relying on cash or bonds are guaranteed to lose wealth. The American dream of saving your way to prosperity is effectively over, replaced by active asset preservation strategies. Understanding these mechanisms is crucial. Without awareness, ordinary citizens are blind participants in a long-term wealth transfer. History teaches similar lessons. After WITHUD, the U.S. reduced debt by allowing negative real interest rates for a decade. Bondholders lost purchasing power, the government reduced debt invisibly, and ordinary citizens effectively financed reconstruction through inflation. The modern approach is upgraded with regulation, statistical adjustments, and central bank involvement to ensure the process is nearly undetectable. Regulatory rules create a captive market for U.S. treasuries, forcing banks, pensions, and insurance companies to hold them regardless of returns. Inflation measurements, including CPI, are adjusted downward, hiding real price increases from the public while reducing government obligations. The Federal Reserve becomes an enabler, stepping in to buy bonds when private markets refuse, maintaining interest affordability artificially. This creates an everything bubble, inflating stocks, real estate, and assets disconnected from underlying economic reality. Investors see apparent wealth growth, but real purchasing power erodes steadily, subtly financing the national debt without awareness. If citizens want to preserve wealth, they must invest in assets immune to government printing and manipulation, avoiding traditional savings. Gold, Bitcoin, scarce real estate, and profitable private enterprises become essential tools for protecting long-term financial security. Cash is no longer king, and government bonds no longer guarantee safety against inflation or negative real returns. This is a systemic shift, replacing decades of predictable financial advice with a reality of forced risk-taking and asset preservation. A digital currency, or CBDC, represents the final tool for the government to enforce wealth redistribution and control entirely. Digital dollars remove physical escape options, enable negative rates, and allow programmed spending, fundamentally altering citizen financial autonomy. This is already being piloted abroad, proving governments can manipulate currency circulation instantly for policy objectives. The slow default mechanism is deliberate, invisible, and historically proven, allowing governments to erode debt while avoiding political fallout. Ordinary Americans, relying on cash or fixed income, become the unintended donors financing the national debt over decades. Asset holders, in contrast, benefit from early access to liquidity injections, allowing them to accumulate wealth ahead of inflation. Wealth inequality accelerates because new money enters the economy through financial institutions before reaching ordinary wage earners. This is the real K-shaped recovery. The top 10% grow richer, while wages and purchasing power for the majority stagnate. Inflation, regulation, and central bank policy combine to systematically shift wealth from Main Street to Washington over decades. To survive financially, citizens must embrace assets the government cannot print, owning tangible or scarce investments as a hedge. Traditional financial advice no longer applies. Saving cash or relying on bonds guarantees loss, while only speculative or tangible assets preserve wealth. The slow default is not sudden. It's deliberate, bureaucratic, and enforced through monetary, fiscal, and regulatory policies over decades. The government is not going to default openly. Instead, they erode debt value while maintaining appearances of fiscal responsibility. Citizens are subtly funding the Treasury by losing purchasing power and inflating away the real cost of debt invisibly. Winners will be those holding tangible assets, scarce resources, or investments resistant to printing and inflationary erosion. Losers are savers, bondholders, and anyone trusting in cash or nominal returns for long-term wealth preservation. The American dream of saving steadily for retirement is dead. Active asset management is now essential for survival. Understanding these tools and mechanisms is critical to preserving wealth in the era of fiscal dominance and slow default. In the next video, we'll examine historical lessons, including gold seizures and strategies used to survive government wealth extraction. Be prepared to see how past governments used legal and regulatory tools to claim private wealth during economic emergencies. Subscribe now, hit the like button, and stay informed to protect your savings from invisible government debt erosion strategies.